This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
So with all that's going on, market watchers, and many of them, and business executives continue to remind us we cannot forget what is going on geopolitically. And on that, the White House is certainly contemplating its next move, weighing potential responses to that deadly attack on a U.S. base in Jordan by Iran-backed militants over the weekend that killed 3 U.S. soldiers, said to be the first Americans to die from such an attack since regional tensions were inflamed, Tim, by the start of the Israel-Hamas war in Gaza, which of course started back in October.
Yeah, Pentagon Press Secretary Air Force Brigadier General Pat Ryder was on Bloomberg Surveillance earlier this morning and addressed a possible U.S. response.
We will take deliberate, appropriate action. Our focus here is not to broaden a conflict from the very beginning. We've been very focused on ensuring that the situation in Israel does not broaden into a wider regional conflict. Unfortunately, what you have here are Iranian proxy groups that are exploiting the situation and conducting these types of illegal attacks against forces that are in the region to actually preserve peace and stability. So again, we're going to do what we need to do to protect our forces, while also cognizant of the fact that what we don't want is a wider regional conflict.
That was, of course, Pentagon Press Secretary Air Force Brigadier General Pat Ryder on Bloomberg Surveillance earlier this morning addressing a possible response. We do also hear from John Kirby, National Security Council Coordinator for Strategic Communications, speaking right now, who did say that the U.S. will respond on the U.S.'s schedule, not on anyone else's.
All right, so let's get to the interview. With us is retired Major General Massar and Robinson. He served in combat zones in Liberia, Desert Storm, Somalia, Iraq, and Afghanistan. He commanded at every operational level in the Marine Corps, so he has seen a lot and has some very deep insight. He is geopolitical intelligence advisor and board member at Academy Securities Advisory. He joins us on Zoom from Greenville, South Carolina. Major Robinson, it is great to have you back with us. Curious in terms of appropriate response. I think we all wonder what that means. What goes into, first of all, you know firsthand, what goes into determining what is an appropriate response?
Thanks, Carol. The first step is attribution. Can you validate who did it? We certainly can validate where the drone came from, but whose fingerprints on the drone can be challenging, particularly when dealing with proxies. And you have to be careful when you're dealing with proxies. The tendency is to say who historically funds or supports the proxies, gloves off, let's go after them. And although that's a popular response, it isn't always necessarily the most defendable response. The second is you have to look at what's our capability to send a response, what's the message that it will send, what's our will to send a response, and then there's the dicey part of our credibility in the response. It's sort of like a parent with the child. I mean, you need to, when you say I'm going to do something, I'm going to do it. So I think the Biden administration is definitely trying to figure out how hard of a response can they address? Can they be specific at the funder or the supporter, or is there a proxy they really can nail down to go after? They'll figure that out and they'll do something. Whether that'll have the desired effect or not is always, the challenge.
Right.
Because these people don't think logically like we do, and they don't respond logically like we do for the most part.
Major General Robinson, what did you make of Senator Lindsey Graham of South Carolina over the weekend tweeting, "Hit Iran now, hit them hard"? First, what do you make of that? Second, does that make the White House's job more difficult?
I don't think it makes it more difficult. I mean, I think we live in a very political world, and people make statements for effect. Historically speaking, there's certainly an argument to be made that there have been administrations in the past, and I don't mean, going all the way back to the 1800s, but in the past who struck very specifically and very hard. And depending on whether you're talking about North Korea, Iran, an African nation, I mean, each one is independent in how you need to measure the calculus of what you're going to do, because they'll all respond differently. Some of them are very, very thick-skinned, Some of them, it doesn't really matter what you do. And some of them, if you can find the sweet spot, you may be able to do something. But attacking Iran right now, I'm not going to say it's a bad idea. I'm going to say it's a challenge as to what do you attack in Iran if you're going to do it, that you can publicly not just argue, but validate that they had a direct fingerprint on what happened. Therefore, this was a justified response.
So is it incorrect to believe that both Washington and Tehran are seeking to avoid a direct confrontation over the widening Middle East conflict? Is that incorrect for us to believe it, that both Iran and the U.S. do not want to see further escalation with those two specifically involved?
Yeah, I don't know that would be an accurate characterization. I think Iran doesn't necessarily want a widespread conflict, but what they definitely want is widespread disruption. They want to disrupt what's happened over the last year plus of going all the way back to the Abraham Accords and the potential partnership between Saudi and Israel, and the partnership within the Gulf that is not just oil-based, but has new economic opportunities. You've got both Egypt and Jordan pretty much saying we're not going to take on the fanaticals in our country. So there's a lot at stake here that's going on that's outside the parameters that I think Iran is very much trying to disrupt. But I wouldn't say they want a war with the U.S.
We have a partial map of the region, but to show where the drone attack was over the weekend that led to U.S. deaths, every time, General, that we look at a map of the Middle East, including the attack over the weekend, we see how close everyone is geographically. We're reminded of how it wouldn't take much for it to snowball. At the same time, seeing how close everyone is, it's reminded us of what many in the region must be thinking about, how easily it could get out of control and how much everyone in the region could stand to lose. And yet this is where we all lean on your experience in the region. You've kind of hinted at some of it. Is how does the region see it? Do they view more attacks as an escalation and something that to be worried about? Or are they like, okay, maybe we'll gain something out of this?
Well, with the U.S. and maybe parts of Europe, probably have a different calculus than some of the rest of the world in regard to human life. Nobody wants to see somebody die, but we probably put a bigger value on 3 soldiers, sailors, airmen, Marines that were in a remote area in a small logistics base on the border of Jordan and
Syria and Iraq.
That they got hit by a indirect issue in their billeting space. The billeting space piece is probably what will get the most attention. That you weren't addressing them while they were doing something that was antagonistic, but you're addressing them while they're sleeping. Part of that is, how do we harden our facilities? How do we ensure that where they're sleeping is not as well known, is more hardened? The fact that it was 30 casualties, you probably can address some of that by a wider separation between who's sleeping where and how they're surrounding what they're sleeping in. You're not going to put top cover on top of it that's going to be bulletproof. So it's always a threat anytime we deploy our forces overseas that they're going to be vulnerable because they're not going to be in hardened facilities. So part of this is a factor of, if people strike us in a soft target like this, we will come after them and we'll make them pay. That's certainly something that I know the administration will be looking at is how do we hit back hard enough to where they go, ouch, I don't want to do that again. But how do we do it in such a way that it doesn't have a second or third order effect that we later regret? And I hate going down a political road, and this isn't political, but we can be victims. We can undermine our message by our previous messages. And so the president's going to have he's going to be challenged to figure out, how do we really hold Iran accountable and make sure they know that we take this very seriously and that we're not going away. because they will measure this whether we want them to or not.
Right.
And I'm not saying this is an apples and apples, but they'll measure it against the pullout in Afghanistan. And the public statement is time for soldiers, sailors, airmen, Marine, the U.S. to stop dying in godforsaken places halfway around the world that we don't care about. That's not what the president intended. That's not what he would do a parallel to here. It's got nothing to do with that. It has to do with what's Iran hearing and what are they stringing together, and how do we send them a different message that makes them sit up and go, okay, this is different. This is not the run of the mill.
Major General, you, first and foremost, we're talking about a story that involves casualties, U.S. deaths. It's a human story. It's a story about conflict, but it's also a story that could have widespread economic implications, as we've seen play out in the region over the past few months. After all, you are an advisor and board member at Academy Securities Advisory. What is the way that you are providing advice right now to your clients, to your company? What is the thing that you're telling them about this conflict?
I think, unfortunately, we're probably faced with the Red Sea avenue of transportation, the Bab el-Mandeb Strait, the Red Sea, and the Suez Canal being certainly problematic. So that's probably somewhere around $1 million increased cost of that ship going down the Cape of Good Hope instead of going through the more direct route. So it's going to be a finance piece that will certainly bleed into inflation and the cost of things. It'll be an insurance piece for shipping that are in key shipping, because nobody's going to insure that ship going through an area that is problematic without really jacking the insurance up to ensuring that it's being paid for. So it will impact the economy. Probably what's happening there in Syria will impact the economy less than what's happening by the Houthis and in the Red Sea.
But is that because you believe what's going on in the Red Sea, it's not going to wrap up anytime soon? It's going to be something that lingers, if you will, this year?
So again, the challenge is who's the audience, and if Iran, I think, is probably more rational than the Houthis. The Houthis don't really have an organizational structure, a national instinct that has them thinking through these calculuses like Iran will have to do as a nation that wants to be influential as a nation. And that's the challenge with irregulars, that are around the world. Honestly, in Yemen, the President Saleh was probably the most effective.
Yeah.
He never controlled the tribes. What he did was he, in essence, brought the tribes into Sana'a, bought their tribal leaders' villas, and kind of the premise, keep your friends close, your enemies closer.
Right.
He knew he couldn't control them, but he tried to influence them in ways that were unconventional. And that's sort of still what you got there with the Houthis and with Yemen as a nation that's more unstructured than Iran is as a nation.
All right. Well, some much appreciated insight, General. So thank you so much for joining us again. That's Major General Massar and Robison, Geopolitical Intelligence Advisor to Academy Securities Advisor. He's also a member of their board, joining us on Zoom from Greenville, South Carolina. I feel like we started the new year talking about concerns about geopolitics. We continue to kind of cautiously use the word escalation, but nonetheless, I guess now we're just kind of waiting to see what the U.S. responds. Or
Notable
how it
to
responds.
see not a big response from oil on this.
Not yet.
Yeah.
Yeah, exactly. All right, folks, just getting started on this Monday. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So one of the things that we love talking about is what's going on with the consumer, the health of the consumer. We do it because it's so important in terms of U.S. economic momentum. And on that, Tim, we've had some recent economic reports showing robust gains in both personal income and spending in December. We also had consumer sentiment soaring in early January to its highest in about 3 years.
Don't forget about the Fed Beige Book. It found resilient consumer spending that helped propel the U.S. economy in recent weeks, offsetting weakness in other sectors like manufacturing. all sounds good.
Yeah, it does sound good.
Everything's great. Everything is awesome.
Not so fast, because credit card
come on,
delinquency
Carol.
rates, sorry to be the bummer here, credit card delinquency rates have exceeded pre-pandemic levels, while the share of borrowers making only the minimum payment climbed above 10% for the first time since 2019. This is according to a Federal Reserve Bank of Philadelphia report, Tim, that was out earlier this month. So that's the bummer part.
Okay, well, let's get into it with our next guest, who's also tracking the credit health of the U.S. consumer. With us is the CEO of VantageScore, Silvio Tavares. Silvio, good to have you with us this afternoon. Here from San Francisco, we should note that VantageScore is a joint venture of Experian, Equifax, and TransUnion. It provides credit data, credit risk modeling, and analytics based out in the West Coast. So you got a recent report out, a December report. Talk to us about specific data points in the report that has you concerned.
Well, yeah, I think the main key point to start off with is that actually the overall consumer is healthy. You know, we measure the consumer credit health by the average Vantage score. A low Vantage score is 300, a perfect Vantage score is 850, and prime, which is the level where consumers usually get the best rate, is Vantage score 660. As you look through the end of December, we published this data today through our monthly credit gauge, the average consumer credit score was 701. So that's actually a pretty healthy score. But what that masks is an area of concern, because basically the consumer is experiencing a bit of a credit hangover.
So average is mean.
Yes, and the average and the mean are the same for credit scores typically, because you see that nice normal distribution.
Average and the median.
Right.
Yes,
Okay.
yes, correct.
So go ahead. You were saying, though, it masks some of the underlying maybe concerns there.
Exactly right, because what we saw in December, which is the data that we published today, was that all of a sudden you're starting to see some signs for concern in terms of the increase in credit card. Credit card balances in December were up over 8.2% on a year-over-year basis. That's a big jump. And as we look also at delinquencies, the rate at which people are paying their loans late, we're actually seeing that increase on a year-over-year basis. It's a little bit of an increase, but when you see that trend, that's always cause for concern. And so the consumer is experiencing a little bit of a credit hangover. They spent a lot in December, and we're going to watch that going through the balance of the year.
Does the credit hangover portend anything more concerning for you than people just owing more on their credit cards? I mean, what are the knock-on effects of this? What has you concerned?
Well, the key concern is if this continues, you're going to see a rising level of defaults and delinquencies. And it's not all consumers are experiencing the same thing. So, for example, for the higher end, higher average age consumer, you're not seeing those delinquencies. But as you look to the lower credit tiers, Vantage score subprime and near prime, there's where you're seeing a higher rate of concern. Now, as you look at banks, you know, I'm using the analogy credit hangover. Well, the banks are still serving drinks. We actually saw credit originations increase in the month of December compared to November, and also increase on a year-over-year basis. So banks, we expected were going to tighten. That didn't happen in December. We're actually seeing banks continue to lend really across most categories. And so we're going to watch that trend, because obviously if you have higher delinquencies coupled with increased lending, that's not a good picture for banks.
We have a chart to share with everybody, and it does show what you guys have seen in terms of credit card balances over the last 4 years. So you can just see from November 22, from December 2022 to November 2023, December 2023, you can see the uptick and the build, right? That gradual build in terms of credit card balances. Having said that, Silvio, give us an idea of, you guys are getting data, right, from all the credit reporting agencies?
Yes.
I mean, so is it a nice cross-section, if you will, in terms of the U.S. population?
Yes, very much so. We have the most authoritative source on that data, because VantageScore actually scores approximately 30 million more consumers than the conventional credit scores. We're used by 8 of the top 10 banks and over 3,000 banks and fintechs. We grew at 30% last year, and approximately 19 billion Vantage scores were used. So it's the most authoritative source. And that's the challenge with a lot of the economic data that you're seeing from other sources right now. It's backward looking. It's like driving in the rearview mirror.
Right.
We have the most recent data, and what it shows is overall the consumer's healthy, but we're starting to see some signs for concern. That delinquency rate increasing is one of them. The spike in credit card balances is another.
I mean, all this has me thinking about the power that the U.S. consumer has when it comes to the economy. I mean, this is an economy that the consumer certainly powers. Are there any macroeconomic takeaways that you can give us about credit score and what it means for consumer spending?
Yeah, well, the credit score, the Vantage score, is the real authoritative source of credit health. And what we're seeing is it's becoming very much of a tale of two cities. Those older, more affluent consumers, Generation Xers, they're actually doing pretty well. So, for example, in December, we saw Generation Xers increasing their credit card balances. But those folks, you don't have to worry about them. They typically have higher average credit scores and higher wealth. What's more concerning is that younger and mid-tier consumer, and when you look forward, they're going to be facing some economic headwinds. The most significant one is student loans. We're seeing those student loans payments kick in.
Is one reason that their credit score isn't as high, or their Vantage score isn't as high, is because potentially they don't own a house, they don't own an apartment, they don't have that credit history that younger generations or older generations had when they were their age?
100%. And what we see is that home ownership is a huge driver of wealth. The average home equity in a home today is $248,000. So if you have a home, you're doing pretty good. If you don't, you have more challenge. And that younger consumer doesn't have as much as an economic cushion to weather the storm against rising inflation and that higher average credit card statement that they have. They also don't have much of a cushion to pay for that unexpected loan repayment. And that's why it's so important. Recently, we saw some of the regulators actually mandate the use of Vantage Score for mortgage. And so we're going to be seeing a lot more of those younger consumers, those underserved consumers getting a chance at their first home. And we expect that to really help with credit health.
I feel like these are a lot of the topics we've talked about in the last year or so. Is there anything, just 30 seconds left here, Silvio, that was surprising to you that you think our investing audience should know about? It might be whether it's cause of concern or cause of calm, if you will, just quickly.
Well, I think the most surprising thing, the most newsworthy thing is the reality that banks aren't tightening the way that we expected. We expected to see into December a cooling economy and banks really pulling back on their loans. We didn't see that. In fact, we saw the opposite. And so that's a key theme we're going to be watching throughout the year. Of course, the whole reason why the Fed increased rates is that they expected banks to tighten somewhat. And actually, we're seeing banks in a very principled way looking to maximize that net interest margin on new loans they're making. So we'll have to continue to monitor that.
All right, we've got to leave it there. Silvio Tavares, CEO at Vantage Score, joining us here in studio. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All around the world.
Well, they certainly will soon in a very expensive arena out on the West Coast. This is one of the most read stories on the Bloomberg terminal. It's about the most expensive basketball arena ever built. How much? Well, we're talking, quote, well north of $2 billion. That's a quote.
Does that even matter, though?
No.
To Steve Ballmer? I don't know. Here's some other numbers to chew on. The arena's got 1,160 toilets and urinals, 199 countdown clocks, a 44,000 square foot halo-shaped LED board, a floor-to-ceiling bank of 4,500 seats on one baseline, and one very enthusiastic and energetic team owner, none other than said Steve Ballmer.
Indeed. Well, last month, Bloomberg News Business of Sports reporter Ira Boudway flew out to L.A. and put on a safety vest, boots, and a helmet to get a tour of the new Intuit Arena. And he joins us here in the Bloomberg Interactive Broker studio, along with the editor of Bloomberg Businessweek, Joel Weber. And Joel, I feel like, when you've got a well-known billionaire spending big time in sports, lots of superlatives, this is a story made for Bloomberg Businessweek and the universe.
There's a genre here where we like to go to stadiums and actually see these facilities kind of come into being. And what's really fascinating about this one is in Los Angeles, the Clippers have always been sort of second fiddle to the Lakers. And forever they were sort of, their schedule had to not only work around the Clippers, but around the Lakers, but whatever else was also happening in LA. When Steve Ballmer bought the Clippers for $2 billion, it started this process to really kind of change the world's perception of what Clippers basketball will look like. The team is quite good, and beginning next season, they'll be playing in their own arena for the first time. He's a basketball junkie, And so his obsession with the stadium and the arena is, I think, this manifestation of that. And Ira got to, you got to wear a hard hat, right?
Yes.
With Ballmer.
Boots, vest, not with Ballmer.
Okay,
I was at Crypto.com Arena, where the Clippers currently play and share with the Lakers, with him, and then I got a tour with the team's president of business operations, Gillian Zucker.
Okay, so take us through like what this is going to be like as a fan of like what Ballmer is trying to build.
It's very interesting because he has a very distinct point of view with it. He wants all the fans basically out of their phones, locked in on the game, cheering loudly, providing a competitive advantage to the home team. He wants basically.
Why wouldn't you want that?
Yeah,
sounds great.
Isn't that why you're supposed to go to a game?
Yeah.
I got a few $2 billion to build a place where that can happen.
But if you want to maximize revenue, arguably you put hundreds of suites where people sort of chill out and kibitz during the game. He's not going for that approach, and he sees this as an alternative to the Lakers, and as a kind of hearkening back to an old style of fandom where you were engaged in the game throughout.
Is the idea that revenue growth happens when the fans get more excited, the team gets better, and then the ticket prices go up?
I think his idea is, look,
or is he Steve Ballmer and he doesn't? Yeah, he's one of the wealthiest people in the world and doesn't care.
He wants 17,500 Steve Ballmers there with him.
Okay,
he is incredibly enthusiastic.
Is he that enthusiastic in person?
In person, he's everything that you've seen in the sort of famous Monkey Boy clips online. He brings that energy, and I think he wants that energy in the arena, and that's his first priority. I think they think that's compatible with making it work financially, and that the part of the reason it can work for the Clippers is that they need to be an alternative in the LA marketplace. The Lakers are one thing. The Clippers are going to be, in his mind, the place for the basketball purists who want to be on their feet all game long.
So to build this, how did they go about finding inspiration?
They went all over the world. They looked at soccer stadiums, and that's where they came up with the idea of having every fan walk down to their seats. So even if you're in the last row, you kind of enter from above and go down.
I love that idea.
Yeah.
Like you just, it never occurred to me, but when you go to a basketball game, you kind of come in and then immediately like turn away from the court as you find your seat, which for me is always up at the top.
Right, in the nosebleeds. They borrowed that from there. They took ideas from all over the world, and everything was focused around the idea of, like I said, keeping people's attention on the game. So they have really limited concessions so that you don't wander the arena looking for your favorite item. They have
there's like a consistency.
Yeah, it's like 8
hot
items.
Dogs are hot dogs.
Yeah,
Don't
it's
go
exactly.
looking for that.
Yeah, and the way they're setting up the checkout is this frictionless. You walk in, you take what you want, you walk out. You don't stop to pay. Tim's
going to try and put everything on my credit card.
Exactly. They have these countdown clocks you mentioned, those 199 countdown clocks. Those are going to show people how much time is left in a timeout before they need to get back to their seats. Even the suites are set up so the seats are in your way. If you're standing in the sort of dining area, typically you can kind of lean on a counter and look out over the game while you're eating and drinking. He's got it set up, no, you got to get back out to your seat to watch the game, so you can't kind of multitask. And this wall is 51 rows of uninterrupted seats, no suites in the way, floor to ceiling. Where you have to be a Clippers fan to get tickets. They're going to have a loyalty program where you have to post something on social media of yourself in a Clippers jersey or answer trivia questions in order to even get access to buying those tickets. And they want it to be like a kind of Cameron Indoor field house feel.
I love that, but I also am just going to guess there's going to be such a program to try and infiltrate that space and just be like the one Lakers fan in the Clippers.
That policing that is going to be really interesting.
Yeah.
They're in
Steve Ballmer is going to be watching that like a hawk.
In Europe, it's traditional. Like you can't wear away colors except for in the away supporter section of a football match there, but we don't have that tradition.
This is
here.
America.
Yeah. Does the NBA have any say in terms of arena, in terms of what needs to be done, or no? An owner can kind of do what he wants, especially when it's his money.
There's a set of standards, but it's pretty you got to have so many seats and you got to have a certain level of amenities and stuff. But in terms of like what he wants to do within that, there's a lot of latitude.
Okay, You didn't mention toilets, which I mentioned at the top.
Right.
Can you talk about?
Definitely for the fans.
I'm sorry, Joel. I'm sorry. I wrote toilets, and I want people to know I'm not the only one obsessed with toilets. Okay.
Right.
I'm
sorry. You go ahead, Joel.
Whatever your level of obsession with toilets, we're gonna see if it tops Steve Ballmer's.
Okay.
Anybody who listens knows we are both obsessed with toilets.
So what was the number? How many toilets does this place have?
1,160, I believe.
Sounds like a
was
lot.
the last count. Yeah, they say it's 3 times the typical NBA arena ratio of seats to toilets. So, and again, the idea with that is he doesn't want you standing in line. The Clippers don't want you standing in line when the game's going on. So they're trying to get you in and out as fast as possible. And so Ballmer, was at the groundbreaking, did a reprise on his developers chant with toilets. The team, they're like trying to get him to say fixtures and like rope it in a little bit. But, it's just about basically he wants hopefully everyone watching the game for every second.
That's the contract. I want to know everything about that contract of just like how you bid on toilets with Steve Ballmer. But look, it's like it's easy to make light of this.
Yeah.
I so appreciate the attention to that level of detail. Like we've all been to games and waited in line to use the bathroom and been like, why am I waiting in line? Like, I'm speaking as a guy here. I mean, it's even worse for female.
Talk about we women.
Yeah.
Real quickly, are ticket prices going to go down? It sounds like this is all about for the fans. Do prices go down? We've only got about 20-25 seconds here.
Prices go up. And they are trying to
toilets
move,
are expensive.
Yes, this thing is more than $2 billion to build, and they're trying to move their fans over from the current arena and bring in new fans. And it's a pretty dazzling new venue that they have planned. So they need to pay for that, and they think fans will
helps that the team's pretty good.
Yeah, I mean that's a big piece. They've got a decent shot at a deep run in the playoffs. So
well, it's a killer story. It's among the most read, and so glad that we could spend some time talking with you. Of course, Ira Boudway, Business of Sports reporter at Bloomberg News, here in studio, along with the editor of Businessweek, Joel Weber.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just under 18 minutes left in today's trading session.
That's
first
it?
of the week. Yeah,
Okay.
18. Yeah, under 18.
Are we going to hit record highs again?
I don't know, but it's really been interesting the last hour or so. I feel like since that one headline crossed, I don't know if there's a direct correlation of U.S. corporate bond sales hitting $176 billion to set a record in January. We have seen momentum build here in the trade, so we are just off our highs of the session for each of the 3 major equity averages. NASDAQ outpacing, up about 1% right now.
And right now, if we were to close right here on the S&P 500 at 49.23, would be closing at a record today.
Yeah, we've seen a few records taken out this year.
Hey, let's see what Jeff Crumpleman has to think about it. He's Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors. He joins us once again on Zoom from Cincinnati. Jeff, we haven't seen you or heard from you in 2024, so Happy New Year. How are you?
I'm great. I think everybody's probably in a pretty good mood right now. So hopefully you guys are as well.
It didn't hurt to open up.
Market, yeah.
Didn't hurt to open up, right? Your 401k statements or pop it open at the end of the year. It was a good ending to the year.
Absolutely.
So you guys called this that you were bullish at the end of last year. Want to get to that in a minute, but I want to talk about 24 because you argue that this is a, quote, back to normal year. Normal economy, normal rates of inflation and interest rates, normal supply-demand conditions in the labor market, as well as levels of labor productivity and normal earnings growth. What makes you so confident that we are finally going to return to normal?
Well, I think, we were confident going into actually 2023, and I know you want to talk about 2024, but I think that sets the table for 2024. And we thought that 23 would be the inverse of 22. All the panic happened in 22. The stock market leads the economy, and the stock market thought we'd have a recession and we would have very weak earnings. And our thesis last year, and the reason we were positive and continue today, is we thought we'd have better than feared outcomes on the economy and earnings, that we would have inflation calming, and that we would have the Fed peaking at interest rate levels that were actually quite normal. And that just kind of played out. And you know what? It's not different. It's not like that's some unusual thing. Most of the time, the fundamentals, the valuation levels, and the technical trends are neutral to positive. And that's where they've been the whole time. And it's everybody else that freaks out and thinks, well, that can't hold. And generally, the data comes out and it proves that, yeah, it's neutral to positive. And it remains that way. Inflation's calmed. We've gotten great economic news with regard to GDP for Q4. We had already had a strong Q3. Consumer confidence is up. Retail sales is strong, and yet inflation's calming, and the Fed can kind of chill a little bit here, while earnings look in that environment to grow about 10%. That to me explains normal. That's what normal is. And I would add to that for everybody that's listening, that also means normal volatility, normal corrective action. The market generally, corrects 10 to 20% each and every year. So it's not a straight line up to new highs. We do have a target of 52 to 5,400 for this year. Last year we had a target of 45 to 4,800, and we were right in between there. And not a lot has changed other than just confirmation that inflation's transitory and interest rates have stabilized
Hold
at
on.
healthy levels and numbers look good.
Carol, he said it. He said the T word.
Transitory?
Transitory.
Yeah.
That's like
fun.
a blast from the past. We all thought inflation was transitory. In the end, was it transitory?
Yeah, it kind of was,
Wow.
It's funny. We made fun of everybody that said it was transitory, and guess what? It was transitory.
Yeah, as a former gymnast, you got to stick that landing and you got to hold it. So I do think, right, we've seen certainly, if you look at the 6-month trend and so on and so forth in terms of inflation or the average, kind of rolling rate, if you will, we're at that 2%, in terms of what the Fed wants. It's just hard to understand if there are some underlying fundamentals that maybe push what the kind of lower end of rates should be, whether it pushes it up. When you look at something like, I don't know, the 2 or the 10 maybe is probably more important. I'm looking at a 4 even. Is that kind of where we should be? That's normal going forward for you, Jeff?
Well, I'll tell you what's normal going back to almost the Civil War. If you look at the data, what's normal is 4.75%. That's the average 10-year yield at various data points. But yeah, we think that the range is going to be somewhere between 375 and 4.5. And the way you kind of, want to put that in perspective, if inflation's running, let's call it 2.5. Right now, the run rate's 2. Might that be getting ahead of ourselves to say we're at 2? Let's call it 2.5. The normal real yield is somewhere around 1 to 2%.
Right.
So if you add to that inflation a real or a 100 basis point to 200 basis point kind of real yield, then you're looking at a nominal yield of somewhere around 4.5%. So yeah, I think that's normal.
Hey, Jeff, you got a ton of stocks that you sent us that you like. We don't have time to get to them all, but a couple that I want to highlight, starting with NVIDIA. You think there's still more room to run higher for NVIDIA?
It's so funny. We look at it's almost like doing fantasy football, where we sit down and you do your picks once a year for something like that. 3 times a year, we really do a deep dive in all the stocks that we own, a deep dive on the fundamentals, the valuation, the technicals, and we rate and rank them. NVIDIA is trading at 30 times earnings. They had 150% revenue growth last year, 250% earnings growth. And they're guiding for about 80% earnings growth this year, and yet they're trading at 30 times. So yeah, I think their end markets are really strong, and I do think that that's a very reasonable price for that kind of growth that's got some runway as GPUs and AI and cloud continue to do real well. And if you don't like NVIDIA, AMD would be also right in there with those same drivers and some real new product catalysts that could drive growth there, linked to the same kind of secular trends.
Well, and as it sits right now, NVIDIA is the second best performing stock in the S&P 500 this year, up about 26% so far this year. It was the number one in 2023. Advanced Micro Devices, AMD, is the third best performing name in the S&P 500. It's up about 20%. No, number 2 is NVIDIA.
Okay.
Number 3 is AMD. Number 1 is Juniper, up about 26%. Yeah, so really some outperformance. Always fun. Happy New Year. Jeff Kruppelman, Chief Investment Strategist, Head of Equities over at Mariner Wealth Advisors.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.